Saving money feels like progress. The number in the account goes up, things feel a little more secure, and we are doing what we were taught to do. I used to think the same way. Keep saving, build a cushion, the rest will work itself out. Then I actually run the numbers on what those savings would be worth in 10 years after inflation. And the answer made me reconsider. The problem isn't saving. The problem is that saving alone doesn't keep up with what's happening to the money on the other side. That's why we invest. Investing is how we make our money grow faster than the prices rise. It's how we stop running in place and actually start moving forward. In this episode, I'm going to walk through what investing really is, in plain language, why it matters more than it might seem at first, and how small amount of money working consistently over time can quietly turn into something significant. Hey, I'm João, and welcome to Investing Basics for Beginners. This whole series is built on one simple idea, that investing isn't actually complicated. Even though it's been made to feel that way for a long time, Wall Street, financial news, fund managers, advisors, a lot of the industry quietly benefits from making this look like a world only experts can navigate. But the reality is much simpler than that. The fundamentals haven't really changed in 100 years, and once we understand them, the noise around them loses most of its power. Across this series, we are going to break down everything we need to know to invest with confidence, starting from zero and building up step by step without hype, just with principles. So let's start with the foundation. What investing really is and why it's not just for Wall Street or rich people, but for everyone. Let's start with the part that's easy to miss, because it explains almost everything that comes after. Saving feels safe, and it feels safe for a real reason, because the number on the screen doesn't change. If we put $10,000 in a bank account today, it still say $10,000 next month, and that constancy is generally reassuring. But the number is hiding something important, and it's not the number itself, it's what the number actually represents. What actually matters is what that $10,000 can buy, and that's where inflation comes in. Inflation is the slow, steady increase in prices over time. Not dramatic, not an event, just a quiet drift in the same direction year after year. The same $10 buys a little less coffee in 2026 than it did in 2020. A little less fuel, a little less of basically everything. The currency stays the same, but the buying power keeps shrinking underneath it. Just to ground this with some real numbers, the Federal Reserve targets inflation at around 2% per year, and although the actual figure moves above and below that depending on the year, over the long run, that 2% is rarely the floor. In recent years, it's been notably higher, so let's use a more conservative 3% to make the math easier to follow. If inflation runs 3% a year, that $10,000 sitting safely in your bank account will only have the buying power of about $7,400 in 10 years, and around $5,500 in 20. We didn't spend a single dollar and we didn't make a single mistake, but the value quietly drained away while we weren't paying attention. Which means, even with a small amount that banks pay us, we are still falling behind in real terms. That's why saving alone isn't enough. Saving keeps money safe from spending, but not from inflation, and investing is how we protect what we have and grow it over time, instead of watching it slowly shrink in the background. So, what is investing really? At its core, investing just means putting money into something that has the potential to grow in value or pay us back over time. That's it. The basic idea is generally simple, and the complexity people associate with investing comes from all the different ways to do it, not from the underlying concept itself. There are three core building blocks worth understanding from day one: stocks, bonds, and ETFs. And once we understand this, the rest of the picture starts falling into place. A stock is a tiny piece of ownership in a company. When we buy a share, we literally own a fraction of that business, which means if the company grows, sells more, expands, becomes more valuable, our share grows along with it. And if it struggle, our share is worth less. Some companies also pay out dividends, which are small portions of profit distributed to shareholders along the way. So, with stocks, the way our money grows is by owning pieces of business that grows. A bond is essentially the opposite side of that coin. Instead of owning, we are lending. When we buy a bond, we are loaning money to a government or a company, and they agree to pay us back over time with interest. Bonds tend to be steadier and more predictable than stocks, but the trade-off is that they grow more slowly. They don't have the same upside, even though they also don't have the same volatility. An ETF, short for Exchange Traded Fund, is a basket of companies. Instead of picking one company, an ETF lets us buy a small piece of dozens or hundreds of companies all at once. The most common type tracks a market index, like the S&P 500, which is the 500 largest public companies in the United States. So, buying one share of that ETF gives us a tiny slice of all of the 500 of them. This matters because it spreads risk. If one company in that basket fails, the others carry the weight, which means we are not really betting on a single business but on the broader economy. For someone starting out, ETFs are usually the smartest entry point. They give us exposure to many companies at once with low fees without needing to research each individual stock. And we'll go much deeper into how to pick and use them in a later episode. Personally, ETFs are also where I started, and they are still the core of how I invest. Simple usually wins. The point underneath all of this is simple. When we invest, our money stops sitting still. It starts working, owning pieces of company, earning interest, generating returns. There is always some risk involved, and we will be honest about that throughout the series. But historically, over long periods of time, investing has consistently outperformed keeping money in the bank. Now, let's see what this actually looks like with real numbers. If we invest $200 a month into a broad stock market ETF and it grows at an average of 7% per year, in 30 years we will have around $230,000. If we simply save that same $200 every month without investing it, just taking it into a regular bank account, we had end up with $70,000. That's a difference of roughly $158,000. With the same effort, the same monthly contribution. The only thing that changed is where the money went. It's worth pausing to explain where that 7% number actually comes from, because it's not a marketing figure, it's the rough, long-term average return of the global stock market once we account for inflation. And although the actual returns swing dramatically year to year, sometimes it's up 15%, 20%, even higher, sometimes down 10%, 20%, occasionally more. Across decades, the average has held remarkably steady. We are not picking 7% because it sounds optimistic. We are picking it because it's a reasonable conservative baseline backed by more than a century of market history. But the part that really explains the gap between 72,000 and 230,000 isn't the percentage itself. It's something called compounding. And I'd say it's probably the single most important idea in investing. Compounding is what happens when our returns start earning returns of their own. In year 1, our money grows. In year 2, that new and slightly larger amount grows. In year 3, the even larger amount grows again, and so on. The base keeps expanding, which means each year's growth is a little bigger than the last. By the time we are 20 or 30 years in, much of the portfolio growth is actually coming from returns on previous returns, not from the monthly contributions we are putting in. This is exactly why time matters more than amount. And it's a counterintuitive but really important point. Someone who invests $100 a month for 40 years will often end up with more than someone who invested $400 a month for 10 years. Even though the second person contributed more total money, because time is a multiplier and the more of it we give our money, the harder compounding works on our behalf. It's also why starting matters more than optimizing. I learned this one a bit late myself. I spent more time than I should have looking for the perfect strategy, the perfect amount, the perfect moment to begin. And meanwhile, the most valuable resources I had just kept leaking away in the background. So, if there is one thing worth taking away early, it's that starting beats waiting almost every time. Let's bring everything together. Saving is important, and we are not going to pretend otherwise. Every one of us needs an emergency fund and a short-term saving for things we will spend on soon. But saving on its own won't build wealth because inflation slowly reduces what our money can actually buy. Investing is how we put that money to work into assets like stocks, bonds, and ETFs that can grow in value or pay us back over time. There is always some risk involved, but over long periods, investing has consistently outperformed keeping money in cash. And the secret weapon underneath all of it is time. Through compounding, even small monthly amounts can become something generally significant when we give them long enough to grow. $200 a month at 7% over 30 years becomes $230,000. Not because we found a magic strategy, but because consistency and time did the work quietly in the background. That's the foundation. Everything else we will cover in this series sits on top of this single idea. Investing isn't about getting rich overnight, it's about making time and consistency work for us instead of against us. In the next episode, we are going to break down the stock market itself, not with complicated charts or Wall Street jargon, but in plain language. Think of it like a giant supermarket, except instead of food, what's on the shelves are companies. We will go through how it actually works, why prices move up and down, and why over time it's still one of the best places to grow our money. If this episode helped clear things up, hit subscribe so you don't miss what's coming. And I will see you in episode 2.